Hi, I'm Michael Yardney and here's my first prediction for 2016. My prediction is that most predictions will be wrong. How do I know? Because they always are. 12 months ago, no one would have thought that the Reserve Bank would drop interest rates twice in the first half of the year, fueling an already hot Sydney and Melbourne property market. Similarly, at the beginning of last year, very few predicted how APRA's measures would constrain investor lending, even though APRA had already started wielding its stick at the time. Now here's my next prediction for 2016. The media is going to be full of negative sentiment this year because our property markets are changing and they're moving into the next stage of the property cycle. Truth is, very few people like change. They see it as scary, so watch out for the property pessimists and doomsayers. Now looking back at 2015, I believe last year is going to go down as a year that our property markets were a two-horse race where the Sydney and Melbourne markets were booming and the other markets were faltering. 2015 was also the year that interest rates fell to historic lows and investors and upgraders responded strongly to the lower cost of money. 2015 was the year our property markets were more fragmented than ever, with many locations falling in value as the two big markets boomed. It was also the year that rental yields fell as rental growth remained at very low levels, and 2015 was when APRA caused the banks to tighten their lending policies and some borrowers had to revise their plans. Now remember, the government engineered the property boom. The housing boom was always part of the government's rebalancing plan. You see, while the mining boom was strong, interest rates were raised to hold back the housing market and other economic sectors in an attempt to keep a lid on inflation during the mining upswing. Then as the mining boom ended, interest rates were cut, which drove a large upswing in housing construction to help fill the gap left by mining. At the same time, low interest rates encouraged us to upgrade our homes. However, property booms can't last forever. Sydney and Melbourne house prices increased 48% and 32% respectively since this cycle commenced in mid-2012. But with our low inflation rate, low interest rates, low wages growth, this sort of price growth is unsustainable. And if property values kept growing at double-digit rates, we would have eventually threatened our financial stability. So how will 2016 compare? An improving economy, strong jobs growth, a stable unemployment. That's likely to mean the Reserve Bank will be able to hold off dropping interest rates further for a while. However, I expect the factors that have driven the recent pullback to housing to persist in this year, with lower house price growth this year. Looking at the crystal ball, I think it's likely that the Sydney property growth is going to slow, but the party's not over. We're likely to see slower, more sustainable markets with property values rising in some areas but falling in others. You see, New South Wales is still our strongest state economically and is creating almost as many jobs as the rest of the country combined. That's going to also lead to strong population growth and buyer demand. But interestingly, there's still an undersupply of properties in Sydney at a time of this continued demand. On the other hand, first home buyers are likely to find Sydney expensive, and rather than move out to the sticks, they're probably going to keep renting and where they want to live, but invest where they can afford to. And the proportion of investors buying into Sydney is going to fall with all the APRA measures. In 2016, Melbourne's likely to outperform all other capital cities. A strong economy, more jobs growth, strong population growth is going to underpin property price growth, but this will be much lower and more fragmented than in the last few years. You see, there's an oversupply of CBD apartments, and this is going to spill into some of the middle ring suburbs where the level of construction of new apartments on a lot of those main roads is ahead of demand. This year, Brisbane property markets are going to pick up a bit, but they won't be the next hotspot like many have predicted over the last few years. The mining slowdown, lacklustre population growth, and lower economic growth has held back Brisbane's property markets over the last few years. But the low Australian dollar and improved tourism outlook will be beneficial for Queensland. At the same time, strong rental yields and relative affordability will see investors moving into Brisbane in 2016. But beware, there's an oversupply of apartments looming in Brisbane CBD, and don't count on the Commonwealth Games to boost the local property markets there, and definitely avoid tourism and regional locations. This year, Darwin and Perth's property values are likely to weaken further, but they could bottom out towards the end of the year. And Adelaide is probably going to keep ambling along as it has the last couple of years without really any big growth drivers to spur it. And the Hobart property market's been hampered by minimal population growth and a sluggish economy. It's not an investment grade market. While there's many reasons to be optimistic in 2016, it's likely to deliver some surprises for us, like every other year has. So if you're considering getting involved in property, why not let the team at Metropole have a chat with you to see where you are and where you want to get to. If you're a beginner, get us on your side, because we've got no properties for sale and our advice is independent and unbiased. If you're an experienced investor, even more reason to use our services, because we have invested through times just like this and our research is showing us where to look and where not to. Give us a call. We'd love to be part of your wealth creation journey in 2016.